Have you ever wondered which investment strategy is the most effective, active or passive? Well, today, we're about to dissect this financial conundrum and shed some light on it. Investment strategies, in essence, are financial game plans that guide your decisions on when, where, and how to invest your hard-earned money. There are two primary strategies that investors often lean on: active and passive investment strategies. Let's break these down. Active investment, as the name suggests, is an involved strategy. It's like being the captain of your own ship, navigating the vast and often turbulent sea of financial markets. Active investors frequently buy and sell assets, constantly analyze market trends, and make decisions based on their forecasts. They aim to outperform the market and achieve higher returns. It's an exciting hands-on approach that requires expertise, time, and a good deal of nerve. On the other side of the coin, we have passive investing. This approach is more about going with the flow, riding the market waves rather than trying to control them. Passive investors buy into a market index or a sector and let it grow over time. They are not concerned with beating the market but matching its performance. It's a laid-back, long-term strategy that requires patience and a taste for consistency. But here's the catch. While active investing might sound more glamorous and rewarding, it's not always the case. It can be risky and costly due to frequent transactions and management fees. On the other hand, passive investing, though stable, may miss out on potential short-term gains and is subject to overall market risk. So we're back to square one: active or passive? Which strategy is superior? But perhaps we're asking the wrong question. The better question might be, which strategy suits you the best? The answer depends on your financial goals, risk tolerance, investment knowledge, and the amount of time you're willing to dedicate. There's no one-size-fits-all approach here. But how do we decide which strategy suits us the best? Let's delve deeper into both. Scene script: active investment strategy, a hands-on approach. But what are the advantages and disadvantages? First, let's explore the bright side. The active investment strategy offers the potential for higher returns. Unlike passive investing, which rides the market wave, active investing is like a skilled surfer, riding high on the crests and skillfully dodging the troughs. It's all about timing the market, buying low and selling high, and if you've got a knack for it, the sky's the limit. Moreover, active investing can provide a safety net during market downturns. While passive investors might watch helplessly as their portfolio value plummets, active investors can take evasive action, shifting to safer assets or even shorting stocks to profit from falling prices. It's like having a parachute when the plane's going down. But now, let's turn the coin over and look at the other side. Active investing isn't all sunshine and rainbows. It comes with its own set of challenges. One of the main drawbacks is the higher fees. Active investing often involves frequent buying and selling of securities, which can rack up substantial transaction costs. Plus, if you're hiring a fund manager to do the job, their expertise doesn't come cheap. And then, there's the potential for human error. Even the most seasoned investors can make mistakes, and in the world of active investing, mistakes can be costly. Misjudging the market, succumbing to emotions, or simply having an off day can turn a promising investment into a money pit. Finally, active investing requires a significant time commitment. Unlike passive investing, which is more of a set-it-and-forget-it approach, active investing demands constant monitoring of market trends, economic indicators, and company news. It's like having a second job, and not everyone has the time or inclination for that. So active investing seems to be a double-edged sword, offering both higher potential rewards and risks. On the other side of the coin, we have the passive investment strategy. What does it bring to the table? Imagine a marathon, not a sprint. That's the essence of passive investing. It's not about beating the market. Instead, it's about keeping pace with it and over time reaping the rewards of steady, long-term growth. So what are the benefits of taking this slow and steady approach? For starters, passive investing often comes with lower costs. Unlike active investing, where you're paying for a fund manager's expertise and time, with passive investing, you're simply buying and holding a market index. This means you're not paying high fees for transactions or management, and those savings can add up over time. Another advantage is the elimination of human error. By simply following the index, you remove the potential for poor decision-making or emotional investing. You're not trying to time the market or pick winners. You're just sticking with the overall market, come rain or shine. But it's not all sunshine and rainbows. Passive investing also has its downsides. One significant drawback is the lack of potential for outperformance. With a passive strategy, you're accepting the market's returns, nothing more, nothing less. So while you won't underperform the market, you also won't outperform it. Another downside is vulnerability to market downturns. Since you're invested in the entire market, if the market takes a downturn, so does your portfolio. You're essentially in the same boat as everyone else without the potential to seek shelter in safer investments. Lastly, passive investing requires patience. The rewards are usually reaped in the long term, and for those seeking quick returns, this strategy might not be the best fit. In conclusion, passive investing offers a low-cost, low-stress approach to investing. However, it also lacks the potential for outperformance and may be vulnerable during market downturns. It's the tortoise in the race, slowly but steadily making its way towards the finish line, irrespective of what the hares are doing. Passive investing, therefore, is a more conservative approach with its own set of benefits and drawbacks. Now that we understand both strategies, the question arises, which one is right for you? Well, let's take a moment to consider this. You see, there's no one-size-fits-all answer to this conundrum. What works best for you depends on several factors. Firstly, consider your risk tolerance. Are you a risk taker, willing to ride the highs and lows of the market in search of potential high returns? Or perhaps you're more of a play-it-safe type, preferring the steadiness of long-term growth. If you're in the former camp, an active investment strategy might be your cup of tea. But if you're in the latter, a passive strategy might be more your speed. Next, think about your investment goals. Are you investing for short-term gains, or are you looking at the long game? If it's quick returns you're after, active investing could be the way to go. But if you're investing for retirement or other long-term goals, a passive strategy can offer consistent, albeit slower growth. Now let's talk time commitment. Active investing is just that, active. It requires time, research, and a fair bit of market savvy. If you have the inclination and the hours to spare, great. If not, a passive strategy, which is more of a set-it-and-forget-it approach, might be better suited to your lifestyle. Lastly, your knowledge and interest in investing come into play. If you're fascinated by market trends and enjoy digging into financial reports, active investing could be an exciting journey for you. If, on the other hand, you'd rather leave the stock picking to the pros and focus on other things, a passive strategy might be the better fit. Ultimately, the best strategy depends on your individual circumstances and investment goals. So take some time, consider these factors, and choose the strategy that aligns best with your personal situation. Remember, investing is not a sprint, it's a marathon. The key is to find a strategy that you're comfortable with and that will help you reach your financial goals in a way that suits you best. To wrap up, let's recap what we've learned about active and passive investment strategies. We've delved deep into the world of investment and explored two prominent strategies that investors employ to grow their wealth. On one hand, we have active investing. This strategy is hands-on, requiring constant attention and decision-making. It's akin to steering a ship through the choppy seas of the stock market, adjusting your course based on market trends, financial news, and economic indicators. Active investing allows for potentially higher returns, but it also comes with higher risk and costs. It's a strategy for those who love the thrill of the chase, who have the time and expertise to analyze the market, and who don't mind paying a bit extra for the chance at superior returns. On the flip side, we have passive investing. This is the set-it-and-forget-it strategy. It's like planting a seed and letting it grow over time with minimal interference. You're not trying to beat the market, you're trying to join it, to ride its waves and benefit from its overall long-term growth. Passive investing is less risky and less costly than active investing, but it also typically yields lower returns. It's a strategy for those who want to grow their wealth steadily over time, who don't have the time or inclination to constantly monitor the market, and who want to keep costs low. Yet, in the grand scheme of things, neither strategy is inherently better or worse than the other. Active investing isn't superior to passive investing, nor is it the other way around. The best strategy is the one that aligns with your personal goals, circumstances, and risk tolerance. So, are you a hands-on sailor eager to navigate the stormy seas of the stock market? Or are you a patient gardener content to watch your investments grow slowly but surely? These are the questions you must ask yourself as you consider your investment strategy. Remember, investing is not a one-size-fits-all approach. It's about finding the strategy that works best for you.